Hello, good afternoon to everyone. Am I audible? My screen is also presentable. Okay, thanks. We will wait for 2 minutes, let other students join, then we'll start the session. Okay. As we are doing the financial management carries 50 marks. It's paper number 10. So there are 18 chapters that I have bifurcated. Introduction to Financial Management, Sources of Finance, Cost of Capital, Leverage Analysis, EBIT, EPS, Indifference Point Level that we had done. Today we will do capital structures and dividend decisions. Capital structure, dividend decisions, cost of capital and leverage analysis, ये चारों एक प्रॉपर एक बंच है. They are very very important chapters. So हम लोग सबसे पहले इन चैप्टर्स पे फोकस करेंगे. Then we will do the working capital management. In today's class, we will discuss cost of capital. We have done cost of capital. In today's class, we will do capital structures and dividend decisions. Capital structure theories and dividend decisions in today's class. First of all, in last class, we had done sources of finance and cost of capital. In sources of finance, we had done from where we will source the finance in the business organization. बहुत सारे मेथड्स होते हैं, तरीके होते हैं जिसके थ्रू हम लोग फाइनेंस को टेक कर सकते हैं, इनटेक कर सकते हैं इन दी बिजनेस. Whether manufacturing, whether service industry, whether other type of industries, से पहले इम्पोर्टेंट थिंग क्या होती है, या हम डेट के थ्रू करें, या हम इक्विटी के थ्रू करें, लोन्स के थ्रू करें, प्रेफरेंस शेयर कैपिटल के थ्रू करें, रिटेन अर्निंग्स हमने पढ़ा था, कैप इक्विटी के ई, प्रेफरेंस के पी, ये सब कॉस्ट ऑफ कैपिटल की डिफरेंट डिफरेंट थ्योरीज भी हमने पढ़ी थी. आज हम बात करेंगे कैपिटल स्ट्रक्चर की. कॉस्ट ऑफ कैपिटल इज कनेक्टेड विद सोर्स ऑफ फाइनेंस एंड कॉस्ट ऑफ कैपिटल होता क्या है? What is the cost of capital? It is the minimum rate of return that any owner expects from the business organization. It is a minimum rate of return. Therefore, we will discuss in today's class what exactly is the capital structure means. Cost of capital is the minimum rate of return. What is a capital structure? Let's discuss today. There are 5 topics that we will do: introduction, features, determinants of capital structure, optimal capital structure, and capital structure theories. Let's start with introduction part. Page number 397 of your study module. It says capital structure theories. If a firm needs a long-term requirements and the working capital, it means if a firm needs long-term requirements and a working capital, the funds are raised through the different source, whether short-term, whether long-term. These long-term are mobilized through the equity share, preference share, retained earnings, and long-term through debentures and debt. The mix of various long-term source of funds employed is known as capital structure. Mix of short-term and long-term source, or we can say mix of various long-term source, not the short-term. Mix of various long-term source of funds is the capital structure. So let's discuss chapter number 14, capital structure. Capital structure is the mix of firm's capitalization, and it includes, we can say, long-term sources of funds. Capital cost of capital is the minimum rate of return, whereas capital structure is the mix of long-term sources of fund, or we can say mix of firm's capitalization. What are the long sources of funds? Like through debentures, through preference share capital, through equity share capital, and we can say through retained earnings. There are other methods as well. So, what is the optimal capital structure? Optimal capital structure क्या होता है? Optimal means proper capital structure. We can say जहां पर हमारा firm एक maximum value पे है. Maximum value means maximum wealth उसकी है. So what is that optimal capital structure? It is if a finance manager choose a pattern of capital structure or we can say choose a pattern of capital which minimizes cost of capital, and second is maximizes the owner's return. It means optimal capital structure is that structure where there is a pattern of capital which minimize the cost of capital and maximize the owner's return. That is the optimal capital structure. So, according to the Gestenberg, capital structure is the composition. It is the composition or makeup of capitalization, includes long-term source like loan, bonds, shares, reserves, and the capital structure is made up of debt and equity shares and refers to the permanent financing of a firm. If a financial manager has to plan an appropriate mix of the different securities, then in such a way that it minimizes the cost of capital, it is a very, very important term. Minimize the cost of capital and maximize the earning per share to the equity share holders. There are patterns like या तो वो सिर्फ इक्विटी कैपिटल के थ्रू अपनी कैपिटल स्ट्रक्चर फॉर्म कर ले, या इक्विटी और प्रेफरेंस के थ्रू कर ले, या इक्विटी प्रेफरेंस इन लॉन्ग टर्म डिबेंचर्स बॉन्ड्स लोन्स फ्रॉम द फाइनेंशियल इंस्टीट्यूशंस के थ्रू कर ले, और इक्विटी प्लस लॉन्ग टर्म डेट इक्विटी प्लस डिबेंचर्स कर ले. They used interchangeably. Firm can use any structure with the bond, any capital structure. This is the capital structure. कि 70% डेट होना चाहिए या 30% इक्विटी होना चाहिए. आइदर 70% इक्विटी हो या 30% हो. इसका मिक्स बनाना कैपिटलाइजेशन का इज द कैपिटल स्ट्रक्चर. वेयर एज हमने कॉस्ट ऑफ कैपिटल में क्या पढ़ा था? वी हैव टू कैलकुलेट what is the rate of return in percentage. KE, KP, KS, KR, KD, these are the things that we have calculated. But capital structure में हम लोग क्या करेंगे? Mix पे ध्यान देंगे. Next is the features of the capital structure. First of all, the main feature is the प्रॉफिटेबिलिटी. जितना अच्छा कैपिटल स्ट्रक्चर होगा, जितनी मिनिमाइज कॉस्ट ऑफ फाइनेंसिंग होगी, मैक्सिमाइज अर्निंग पर शेयर होगा, ऑटोमेटिकली कंपनी इज इन प्रॉफिटेबल पोजीशन. सॉल्वेंसी. कैपिटल स्ट्रक्चर इस तरह से इंश्योर होना चाहिए दैट देयर इज नो रिस्क ऑफ बिकमिंग इंसॉल्वेंट. बिकॉज अगर हमारे डेट एक्सेस में हो जाएंगे, then it threatens the solvency of the company. हमेशा याद रखना, हमेशा हम लोग जब भी कंपनी की फाइनेंशियल पोजीशन देखते हैं, we will always see the debt equity ratio. Debt equity ratio is that ratio. Due to this हमें क्या पता चलता है कि कंपनी की solvency कितनी है. डेट अपॉन डेट प्लस इक्विटी हमारा कितना है, उसकी डेट इक्विटी के अकॉर्डिंग कितने टाइम्स है. This is the thing that we will always have to take care of while taking care of the solvency of the organization. Because solvency के बेसिस पे ही हम लोग रिस्क को मैनेज कर सकते हैं, रिस्क को हम लोग क्या कर सकते हैं, भाप सकते हैं. नेक्स्ट इज द फ्लेक्सिबिलिटी. फ्लेक्सिबिलिटी इज व्हाट इट मीन्स कि हम लोग की जो फर्म्स की कंडीशंस होनी चाहिए वो इस तरह से होनी चाहिए दैट कभी भी हमारे को इंटरचेंज करना हो कैपिटल स्ट्रक्चर को, इंक्रीज करना हो प्रेफरेंस शेयर्स या लोन्स के थ्रू पैसा लाना हो, तो दैट कंपनीज पोजीशन शुड बी एप्रोप्रिएट. कैपिटल स्ट्रक्चर वो होता है जो फ्लेक्सिबल होता है. कंजर्वेटिज्म. Conservatism means that total capital structure does not exceed the limit which the company can bear, or we can say it has the ability to generate the future cash flows. It should not be in the conservatism in the sense that debt content should be, जो कंपनी का डेट कंटेंट है वो ज्यादा ना हो एक लिमिट से. दैट इज द कंजर्वेटिज्म. Control. The capital structure should be so devised that it involves minimum risk of loss of control of the company. Because जितने ज्यादा हमारे debentures होंगे उतना हमारी कंपनी को रिस्क होगा. Therefore, main features of appropriate capital structure is the profitability, solvency, flexibility. This is very, very important in the theoretical viewpoint. Next is the determinants of the capital structure. As we had done introduction, features, and we will do the determinants of the capital structure. We had also done what is the optimal capital structure. So, in the determinants of the capital structure, what are the determinants? They are the factors. Following are the factors which influence the capital structure. First is the trading on equity, EBIT, EPS analysis. We had done what is EBIT, what is EPS. EBIT is earning before interest and taxes. It is the part of the sales minus variable cost is the, we can say, contribution. Contribution minus fixed cost is the profit. प्रॉफिट बोल सकते हैं उसको, हम लोग EBIT भी बोलते हैं, अर्निंग बिफोर इंटरेस्ट एंड टैक्सेस. माइनस करते हैं depreciation minus interest minus taxes. What will we get? We will get the EBT or EAT after tax. It is EAT. EAT divided by number of shares, we will get the EPS. इन सब में क्या हमारी इंटरलिंकिंग है? ट्रेडिंग ऑन इक्विटी में कैसे डिपेंड करता है? ये इसका मेन इंपॉर्टेंट फीचर है और वी कैन से फैक्टर है ऑफ द कैपिटल स्ट्रक्चर, बिकॉज प्रेफरेंस शेयर कैपिटल will also result in increasing the EPS, but the leverage effect is more pronounced in case of cost of debt, because DFL हमने बात की थी, DOL जितना ज्यादा होगा उतना हमारी कंपनी के लिए रिस्क होता है, जितना कम होगा उतनी कंपनी के लिए बेटर पोजीशन में है. So there are two things that you have to take care on in trading on equity and EBIT EPS analysis. Cost of debt, that means KD, cost of debt is usually lower than the cost of the preference capital. Interest paid on tax is tax deductible. It is tax deductible. Because दोनों का हमारी अर्निंग पर शेयर पे इफेक्ट पड़ता है. बिकॉज फाइनेंशियल लीवरेज एक ऐसा मेन इंपॉर्टेंट लीवरेज है जिसके थ्रू हम प्लानिंग कर सकते हैं कैपिटल स्ट्रक्चर्स ऑफ द कंपनी की. हाई लेवल ऑफ EBIT can make more profitable use of high degree of leverage to increase the return on the shareholders equity. EBIT EBS analysis is an important tool for the financial manager जो एक कंपनी की प्लानिंग कर सकता है. किसके लिए? कैपिटल स्ट्रक्चर के लिए. He can analyze the possible fluctuations in EBIT and better different plans under the financing situations. Second is the growth and stability of sales. The important factor which influence the capital structure of the firm is the growth and stability of sales. It means stable earnings. Due to sales, we will get the better earnings. If the firm will not face any difficulty in meeting its fixed commitments of interest, because if company is paying the debt, payment of interest, repayment of debt and a proper time, then firm can raise a higher level of debt. In the same way, अगर हमारी growth of sales affect करती हैं capital structure decisions को, because greater the rate of growth of the sales, greater will be the use of debt. We can say greater the growth of sales, greater will be the use of debt. जितनी ज्यादा सेल्स उतने ज्यादा डेट्स हम लोग ले सकते हैं. इवन लेने के साथ साथ फर्म्स हमें फाइनेंशियल इंस्टीट्यूशंस हमें बोल सकते हैं कि हाँ आप हमसे लोन ले लो तो हमारी सेल्स अच्छी है. नेक्स्ट इज द कॉस्ट ऑफ कैपिटल. कॉस्ट ऑफ कैपिटल इज द मिनिमम रेट ऑफ रिटर्न. ओवरऑल कॉस्ट ऑफ कैपिटल इज द मिनिमम. इट मीन्स हमारी कॉस्ट ऑफ जो हमारे सप्लायर्स एक्सपेक्ट करते हैं, जो मिनिमम रेट ऑफ रिटर्न वो हम प्रोवाइड कर पा रहे हैं. तो दैट मीन्स हम लोग डेट कैपिटल इज द चीपेस्ट source because the interest is paid on in whether it makes profit or not. हमें डेट कैपिटल के अगेंस्ट में पैसा देना ही पड़ता है बिकॉज हम लोग जो मिनिमम रेट ऑफ रिटर्न जो हम एक्सपेक्ट कर रहे हैं सप्लायर्स एक्सपेक्ट कर रहे हैं हमसे, तो वो एक रिस्की पोजीशन होती है बिकॉज शेयर होल्डर्स बियर्स दी हायर रिस्क. जो हम सबको पता है कि शेयर होल्डर्स को तभी पैसा मिलेगा जब हमारा EBIT अच्छा होगा, अच्छी पोजीशन पे होगा. लॉस होगा तो नहीं मिलेगा. Therefore, debt capital is the cheapest source because हमें इंटरेस्ट तो पे करना ही करना है, चाहे वो प्रॉफिट हो कंपनी का चाहे ना हो. Moreover, interest on debt is the tax deductible, which makes it further cheaper. So, preference share capital is also cheaper than the equity capital as the dividends are paid at the fixed interest, fixed percentage. So, we have to design the capital structure very carefully so that our overall cost of capital will get minimized. This is the whole scenario of the cost of capital. Next is the control. Control, therefore, we can say whenever additional funds are required, management has to raise the funds without any loss of control over the firm. Because if equity shares are issued for raising funds, the control of existing is diluted. हम लोग इक्विटी शेयर्स के थ्रू पैसा लेके आते हैं, अगर हमें ज्यादा पैसे की जरूरत है, देन जो हमारे एग्जिस्टिंग शेयर होल्डर्स हैं उनका कंट्रोल थोड़ा डाइल्यूट हो जाएगा, कम हो जाएगा. Because of this, they may raise the funds by issuing fixed charge bearing debts. हम लोग डेट के थ्रू या प्रेफरेंस के थ्रू हम लोग कर सकते हैं, बिकॉज जो डिबेंचर होल्डर्स हैं और हमारे प्रेफरेंस शेयर होल्डर्स हैं, they do not have the voting right. That financing is advisable. It is very, very important because in MCQ types, if the question is asked from you or in the interview sessions also, in a practical scenario, आपसे question पूछा जाए that in your scenario, if a company is issuing, has to raise the fund, company को funds raise करने हैं, through equity करे, through share, preference shares capital करे, या through the debentures करे, या फिर loans के पैसा ले, तो आप क्या एडवाइस करते हैं? सबसे पहले आप उसकी डेट इक्विटी रेशियो चेक करोगे. सेकेंड, आप देखोगे कि अगर हमारे एग्जिस्टिंग शेयर होल्डर्स को कोई प्रॉब्लम नहीं है, हम लोग अपनी सेल्स अच्छी हैं, तो हम लोग क्या करेंगे? सबसे पहले debt financing is advisable in the viewpoint of control, but over dependence on debt capital may result in the heavy burden on the interest and fixed charges that will lead to the liquidation of the company. This is all in the viewpoint of control. Next is the flexibility. Flexibility means the capital structure should be flexible to raise the additional funds whenever required. हमें additional funds चाहिए. The capital structure should be flexible without much delay and cost. The capital structure इस तरह से डिजाइन होना चाहिए that हम लोग अपनी फंड्स को इकोनोमाइज कर लें एंड प्रेफरेंस शेयर होल्डर्स और डिबेंचर्स की हाईएस्ट फ्लेक्सिबिलिटी होनी चाहिए इन दी कैपिटल स्ट्रक्चर, बिकॉज दे कैन बी रिडीम्ड एट द डिस्क्रिशन ऑफ द फर्म, नॉट फ्रॉम द ओनर्स व्यू पॉइंट, बिकॉज ओनर्स आर द वी कैन से इक्विटी शेयर होल्डर्स के से पूछ के हम कर सकते हैं, वेयर एज इन केस ऑफ प्रेफरेंस शेयर्स एंड डिबेंचर्स हम लोग उनको रिडीम कर सकते हैं जब हमारी फर्म चाहे. That is the flexibility. Next is the marketability and timing. What does marketability means? Marketability means there are different scenarios. If the firm, the conditions of the market is changing from time to time. For example, if the company is in growth or in the depression period, or we can say it is on the steady sales, then or in the boom condition, according to the different conditions and timings of the marketability positions, हमें अपने capital structure को change करना पड़ता है, because sometimes there may be a depression at over times, might be boom conditions in the market. For example, take an example in the COVID situation. In the COVID situation, the sanitizers that we are using, the factories that they are जो बना रही थी factories, वो एकदम से कहाँ पहुंच गई हैं? वो boom position पे पहुंच गई हैं. Otherwise, जो दूसरी industries थी, for example, if clothing industry, let's take an example, they are into the depression session. So therefore, it depends upon the timing or the marketability. किस तरह से डिटॉल कंपनीज, अदर कंपनीज, उनके प्रॉफिट्स बहुत हाई हो गए हैं. सर्विस प्रोवाइडर्स में बात करूं, हमारे जो इंटरनेट कंपनीज हैं, टेलीकॉम इंडस्ट्रीज हैं, दे आर ऑन अ बूम पोजीशन, वेयर एज अदर सर्विस LIC और जो हमारी हेल्थ इंश्योरेंस सर्विसेज हैं, दे आर इन बूम पोजीशन. बट अदरवाइज अगर हम दूसरी सर्विस इंडस्ट्रीज की बात करें, लाइक कार इंडस्ट्रीज, लाइक अदर इंडस्ट्रीज, वो सब हमारी डिप्रेशन पीरियड में है. बिकॉज हमें कंपनीज में उसकी मार्केटेबल और टाइमिंग पोजीशन के अकॉर्डिंग अपनी कैपिटल स्ट्रक्चर को रीस्टेट करना चाहिए. इट द फर्म शुड डिसाइड वेदर टू गो फॉर इक्विटी और डेट. बेटर वी हैव टू टेक केयर ऑफ, चाहे हम इक्विटी की तरफ जाएं या डेट की तरफ जाएं, market sentiments into consideration, taking care of the market sentiments or market conditions. In case of depressed condition, the firm should not issue equity shares. This is a very important in terms of MCQ plus in your practical aspect. If I'll ask the question from you that in case of a depression session, example, in case of the clothing industries, shall we issue the shares from the equity capital or share capital? It means we cannot issue the shares, equity shares, but we will go for the debt capital. On the other hand, in the boom condition, it becomes easy for the firm to mobilize the fund by issuing the equity share capital. Internal condition may also determine the marketability of the security. For example, high levered firm find difficult to raise the additional debt in case of a firm may find it very difficult to mobilize the fund and securities because of its small size. Reason being, high levered firm find it difficult to raise the additional debt. Why it is so? Because they are already levered firm. A firm may find it difficult to mobilize fund, any kind of security because of its small size. So we can have an optimal structure to know about the flexibility, control, marketability, timings, sales. These are the factors that influence the capital structure. Next is the flotation cost. What is the flotation cost? Flotation cost, as the name indicate, we can say underwriting commissions and these type of cost that incurred in the securities. So these costs are incurred when the funds are raised externally. Underwriting commissions, issue of prospectus, brokerage commissions, these are the flotation cost. Cost of flotation for debt is less than the equity. Always says cost of debt is less. The main thing during the debt is that we have to pay the interest. But for the equity, whether firm is in the profit or loss, that a minimum एक प्रॉपर एक मिनिमम बनाना पड़ता है. अगर रिटर्न नहीं मिलेगा टाइम विद प्रॉपर टाइमिंग्स तो हमारी फर्म की गुडविल पे भी इफेक्ट पड़ता है, मार्केट अर्निंग पर शेयर पे भी इफेक्ट पड़ता है. So there may be a temptation for the debt capital because there will be no flotation cost in case of retained earnings as well. So flotation cost is also considered as the main important factor in deciding the issue of securities. Next is the purpose of financing. Purpose of financing means we have to check if the funds are raised for the productive use, machines खरीदनी है या कोई और purpose के लिए करना है, then debt capital is appropriate as interest can be paid out of profits from the investment, but if it is for the unproductive use, then equity is the preference. Determinants are very important because in these determinants you can get the MCQ type questions. Last is the legal requirements. Legal requirements means according to the government's timeline, it is changing from time to time regarding the issue of shares, debentures. It should be kept in mind the legal requirements also in deciding the capital structure of the company. So essential features you will do by your own. Optimal capital structure we had done. Optimal capital structure means right mix of debt and equity in the long-term capital structure. So next topic is we had done with the determinants of capital structure. In capital structure, we are pending with the capital structure theories. So let's start with the capital structure theories. There are different approaches. First is the net income approach. Second is net operating income approach. Next is Motilal-Miller approach. And last is the traditional approach. Capital structure theories, there are 4 types: net income approach, net operating income approach, Motilal-Miller approach, and traditional approach. So, first of all, we will write the assumptions. इन theories को पढ़ने से पहले हम लोग कुछ assumptions determine करते हैं in mind कि हमने इन theories पे जाना है, formulas करना है, but ये हमारी कुछ assumptions है जो हम लेके चल रहे हैं. Let's discuss the assumptions one by one. First assumption is there are only 2 sources of funds, that is debt and equity, where no preference share capital is there. Second is the total assets of a firm and its capital employed are fixed. Total assets of a firm and its capital employed are fixed. There will be no change in capital employed. Next is the all earnings are distributed to equity shareholders. All earnings are distributed to the equity shareholders. It means there is no retained earnings. Fourth is the firm earns operating profits and it's expected to grow. There will be no losses. Next, these are the assumptions of the theories. The business risk is associated or we can say business risk is assumed to be constant and is not affected by the financing mix decisions. It means there is no change in fixed cost or operating risks. There are no corporate or personal taxes. This is also assumed that there are no taxes, no taxation. These are the journal assumptions. And last one is the investors have same subjective profitability distribution of expected earnings. It means no difference in investors' expectations related to the earnings rate of return. These are the assumptions. First is the no preference share capital is there, no change in capital employed, no retained earnings, no losses, no change in the fixed cost, no taxation, and no difference in the investor's expectation. In this, we have to take care of the basic definition. Then we will start with one by one theories of capital structure. First it is S is equal to market value of common shares. D is equal to market value of debt, and V is equal to S plus D, market value of shares plus debt. V is the market value of firm. We can denote the market value of firm as V. So let's begin with first approach or first theory, that is net income approach. Any doubt till features, determinants, we can say in assumptions or in basic definitions? Then we will start with the last topic of capital structure, important topic, that is the capital structure theories. Okay, first of all, we will start with the what does net income approach says. What net income approach says to us? It is if the value of the firm is maximum at a point, I'm writing in sub points and then we will discuss through the study module. Value of the firm is maximum at a point where WACC means weighted average cost of capital. Weighted average cost of capital we had done in the chapter. In this we had done weighted average capital means the cost of debt, in the cost of capital that we have done. Cost of capital, cost of debt, cost of equity, retained earnings, preference shares, all the long-term debentures or the long-term equity shareholders, all the long-term mix, plus multiply by weights, we will get the overall weighted average cost of capital, where average cost of capital is minimum. Or we can say increase the debt capital employed increase the debt capital employed, decrease shall be overall cost of capital. If the debt capital is more, then overall cost of capital is less. Therefore, increase shall be more shall be the value of the firm. In net income approach, debt capital, if the debt capital is more, overall cost of capital is low, therefore value of the firm is the more at a maximum point. WACC is minimum and value of the firm is at maximum point. In this, we also have to take care of the assumptions in this theory. First is KD. KD means debt is less than the KE. And second, KD and KE remain constant at all the levels of debt equity mix. They are constant at all the levels. Therefore, the formula is KO is equal to EBIT upon value of the firm. This is the formula according to the net income approach, or graphically if we can say, this is the y-axis, this is the x-axis, this is the degree of leverage, this is the cost of capital, this is the KD is constant, this is KE is constant, and this is overall cost of capital. This is the net income approach. Or we can say market value of equity that is the S. I've already written market value of the shares that is the S is equal to net income divided by KE, cost of capital. Net income divided by KE. This is the net income approach. I hope there are in your study module, there are 4 types of approaches: net income, net operating income, traditional, and Modigliani and Miller hypothesis. These are the assumptions that I have already written. This is the basic definitions. What does NI and NOI means? I will tell you. NOI is the expected net operating income, because हम लोग अभी start करेंगे with the NOI approach, means EBIT. NOI is equal to EBIT. What is net income and what is the difference between net income and net operating income? Net income is equal to net operating income minus interest is equal to net income, or the shareholders earning minus interest. So we had done with the net income approach. Complete. Net income approach, there is an example. Example is EBIT of PHI India is 5 lakh. Company has 10%, 20 lakh debentures. KE is 16%. You are required to calculate the market value of equity and the value of the company. And second is the overall cost of capital. It is according to NI approach. First of all, we have given EBIT. EBIT minus interest is the net income. EBIT minus interest is the NI. हमेशा याद रखना. EBIT, this is the formula. EBIT minus interest, and EBIT is net operating income, minus interest is the NI. If we have given EBIT, then minus interest we will get the net income. KE is given, then market value of equity is NI upon KE. And market value of debt is already given, 20 lakhs. So V is equal to debt plus equity, that is 38 lakh 75,000. And whereas overall cost of capital, that is KO. Overall cost of capital, just a minute. KO is equal to EBIT upon value of the firm. I have already written here. EBIT upon overall cost of capital is the EBIT upon value of the firm. EBIT upon value of the company. EBIT is 5 lakh and value of the company is 38,75,002. We will get the 12.90. Any doubt in this question? Page number 402, question number 22, because these type of questions are very important in examination viewpoint. Any doubt in these questions? In this question? How we have calculated market value, how we have calculated overall cost of capital. Okay. Next, we will start with the net operating income approach. We can also say NOI approach. NOI is equal to EBIT. Value of the firm is equal to market value of firm. V is equal to NOI EBIT upon KO. KO is overall cost of capital. We can say it depends upon the business risk of the firm. It depends upon the business risk of the firm. It is not affected by financing mix. We can also say, according to this approach, capital structure decisions of a firm are irrelevant. We can say, according to EBIT, the capital structure firm decisions are irrelevant because any change in leverage will not lead to any change in total value of the firm and market price of shares. Here, the KO is independent of degree of leverage. KO is independent of degree of leverage because degree of leverage according to DFL it is EBIT upon EBT. Any change in the leverage will not lead to change in the total value of the firm because equity is different and the market price of the share, because KO here is the here it is a KO EBIT upon KO. KO is the independent of degree of leverage. KO is different from the degree of leverage. There are assumptions in these theory. Assumptions are same as NI approach, that is KD should be less than KE, KD remains constant at various levels of debt equity mix. KE increases as debt content increases. Why? Due to higher financial risks and higher expectation of equity investors. So the formula of NI approach is, according to NI approach, KE is equal to earnings available for equity shareholders as EBIT, we have already discussed, minus interest divided by value of equity, or we can say KO is equal to KE S upon V plus KD D upon V. We will write what is S, what is V. V is the market value of the firm, D is the market value of debt, S is the market value of shares. And KD and KE is the percentage amount, market value of equity, market value of the value of the firm, market value of the debt. Or KE is equal to KO V upon S minus KD D upon S. This is the formula, and graphically it is the degree of leverage, cost of capital in percentage, KD remains constant, KO and KE. KE is greater due to, rate is greater due to highest financial risk and higher expectation of the equity shareholders. KE increase as the debt content increase. This is the graphical presentation of the NOI approach. This is the net income approach, operating income approach. Here is the question. Operating income is given, cost of debt is given, company employs 15 lakh of debt and KO is given. 15%. We have to find out the total value of the company. So we have to find out total value of the company. कैसे compute करेंगे? EBIT minus interest. We will get the earnings available for the equity shareholders. That is the net income. EBIT upon KO. Here I have already written. Market value of the firm is EBIT upon KO. EBIT upon KO. EBIT is 5 lakh. KO is 15%. We'll get the value of the company. We have to find out the cost of equity, that is KE. The formula for KE is KOV upon S minus KDD upon S. You have to compute with the following formula. Market value of the debt is given, that is 15 lakh. Market value of the firm is already given. Market value of equity is 18,33,333. And KE is equal to earnings available divided by value of equity, that is 19.09%. With this formula, this is also same. So KE is also earnings available for equity share capital divided by the value of equity. I will also write here. Yeah, here it is. KE is equal to earnings available, that is EBIT minus interest divided by value of equity. Here it is, you can use this first formula. EBIT minus interest divided by value of equity 18,33,333. That is 19.09% that we have to find out. That is the illustration 23. Any doubt in this question? I hope it is clear to you. Okay. Then we will come to our next approach, that is the Modigliani and Miller approach, that is the MM approach. In this, we can say it is a refinement of NOI approach. Higher the financial risk, causes higher the equity capitalization rate. There are also assumptions in MM approach. First assumption is KD is less than KE, as this assumption is for all the whether NI approach, whether NOI approach. Third is MM approach. Second is also same, KD remains constant at various levels of debt equity mix. Third is KO is constant. Next, KE is more as debt content is more due to higher financial risk and higher expectations of equity investors. The capital markets are perfect. In perfect market, capital markets, only this approach is applied. All investors are rational as they are free to buy and sell securities. Free to buy and sell securities. And last is there are no transaction costs. So first is proposition 1. Proposition means first method. Market value of firm is equal to NOI upon KO. Graphically it is KO is constant, and according to proposition 2, KE is equal to KO plus KO minus KD D upon S. KO is overall cost of capital. DS is debt equity ratio, and KD is cost of debt, and KE is cost of equity. And graphically this proposition says Y0x DOL, cost of capital in percentage, KD, KO, KE. That is the KO, that is the KE, that is the KD. This is all remains constant, and they are going to increase as debt increase, KE increase, overall capital is also increased. So this is the Modi-Gilani approach, approach. And last formula for approach is the value of the unlevered firm. Value of the unlevered firm, that is VU, is equal to EBIT upon KO 1 minus T, that is the taxes. This is the approach. Every approach, I hope that you have to अपने पूरा focus देना है with this on the study module, line by line, एक words पढ़ के. In case of any doubt, you can please ask. Basic propositions, assumptions. Proposition 1, what does it says? This arbitrage process is in your homework that you will do by your own. It is very, very important. This is the proposition 2 that we had done. And criticism is also in your homework. To find out the value of the unlevered firm. This is also in your homework. What is the trade-off theory? And what is the pecking order theory? Trade-off theory and pecking theory, no problem. I will discuss in brief what is the trade-off theory and what is the pecking order theory. Before that, we are left with the traditional approach. Let's start. We'll cover up the chapter Capital Structure Theories. Practical portions, it is in your homework, you will revise each and every question from the study module. What does traditional approach says? It says debt is the cheapest source of finance. Then the equity. Due to taxation and investors' risk expectations. This traditional approach says we can say use of cheaper debt fund reduces the overall cost of capital and weighted average cost of capital, since increase in the total capital structure, or can say hence higher the degree of financial leverage, degree of financial leverage is EBIT upon EBT. It means higher the fixed charges, higher is the financial risk, higher is the DFL, lower is the weighted average cost of capital, it is lower. With every increase in debt content in total funds employed, in total funds employed. This is the traditional view. There are three stages: stage 1, stage 2 and stage 3. Stage 1 KD, stage 2 KE, stage 3 KO. You have to read these three stages accordingly. The formula that I will write in the traditional viewpoint else it is the formula is same, that is the earnings available for equity share capital divided by the value of equity. This is in your homework. And overall cost of capital, it is same. KE is equal to KOS upon V and KD D upon V. It is the KO. KO is equal to KE S upon V plus KD D upon V. This is the overall cost of capital and the value of the equity shareholders. So these four theories are completed from my side. Two topics are pending, that is the trade-off theory and the packing order. Let's have a brief idea, but you will do, because theoretically they are very important. Question may ask from this, what is the trade-off theory and what is the in 2 marks or in 4 marks. So let's discuss. Trade-off theory of a capital structure refers to the idea company chooses कितना अपना debt लगाए कितनी अपनी इक्विटी लगाए ताकि बैलेंसिंग हो जाए हमारी कॉस्ट एंड बेनिफिट्स एनालिसिस की. Trade-off theory basically entails the offsetting the cost of debt against the benefits of the debt. There are two concepts in the trade-off theory. First is the cost of the financial distress and agency cost. Agency cost is the other cost. The purpose of trade-off theory is to explain the fact that companies usually finance partly with debt and partly with the equity. That is the trade-off. Advantage of to financing with debt, the tax benefit मिलता है हमें debt से, और cost of financing with the financial distress includes the bankruptcy cost of debt and non-bankruptcy cost of debt, that is staff leaving, suppliers demanding, disadvantages payment terms. ये सब हम लोग बच जाते हैं. तो इन दोनों का कॉस्ट एनालिसिस करना और कॉस्ट एंड बेनिफिट एनालिसिस करना इज द ट्रेड ऑफ थ्योरी. So you will read this trade-off theory on your own. And what is the pecking order theory? It is based on the asymmetric information in which there are differs a situation in which different parties have different informations. Every person manager will have better information than the investors. This theory states कि हम लोग बेटर है इशू करें डेट को when they are positive about the future earnings. अगर मैनेजर को अपना एज ए प्रोफेशनल है, उसे पता है कि मेरी ग्रोथ होगी, मेरी फ्लेक्सिबिलिटी है, मैं कंट्रोल कर सकता हूँ, मैं अपने सेल्स अगर मेरी ग्रोथ होगी इंटरेस्ट को पे कर सकता हूँ, अगर वो पॉजिटिव है अपनी फ्यूचर अर्निंग्स को लेके, देन हम इसको प्रेफर करेंगे कि इशू करे डेट. Equity is issued when they are doubtful and internal finances insufficient. तब हम लोग इक्विटी पे फोकस करेंगे. What does pecking theory says? अब ये तो हम डेट और इक्विटी की बात करी. Pecking theory argues that capital structure decision is affected by the manager's choice of a source of capital, which gives higher priority to the sources that reveals the least amount of information. पैकिंग थ्योरी आर्ग्यूज करता है जो हमारे कैपिटल स्ट्रक्चर के डिसीजंस है ना इज अफेक्टेड बाय द मैनेजर्स चॉइस. बिकॉज जरूरी नहीं है कि हर एक मैनेजर्स के पास कंप्लीट नॉलेज हो. It gives priority to the sources that reveals the least information of the information. There are two kinds of equity, internal and external. Debt is cheaper than both internal and external because of interest. So in this pecking theory, first of all, managers' first choice is to use the internal finance. Second, in essence, internal finance, they can use the secured debt, unsecured debt, hybrid debt. Managers may issue new equity shares. Therefore, under this theory, there are three rules. These are very, very important. Use of internal financing first, issue debt next. सबसे पहले अपने घर में ही देखो कितना पैसा पड़ा है in retained earnings और in other sources. Second, जब उसको डेट पे जाओ. लास्ट ऑप्शन, थर्ड रूल इज नए इक्विटी शेयर्स को तभी इश्यू करो जब कोई चारा ना हो. This is the pecking order theory. This is very, very important in the theoretical viewpoint. So I hope that this capital structure, it is clear to you. We have done with introduction, features, determinants, optimal capital structure and capital structure theories, trade-off theory and the pecking order theory. Plus there are practical questions from page number 411. Till 418. There are practical questions. You will solve each question In case of any doubt, you can please ask. I hope that you will revise all your practical portions plus theoretical portions, because in examination viewpoint, both the theory concept and the practical concept are important, because as far as if the theory is clear, automatically your practical portion, it is easy for you to solve the practical questions. So we have still time left. We will start with our next chapter, that is the dividend policy. In dividend policy, we have to do the topics like introduction, what are the dividends, why a dividend policy is important, significance of dividend policy, types of dividend, dividend models, and determinants of the dividend policies. So let's discuss one by one. In case any doubt in capital structure, or if you have any question related to capital structure, then you may ask. Then I will start with the dividend decisions. Okay, dividends, as we all know, it is a major cash outlay for many corporations. We can say it appears that companies could distribute as much possible as to please its shareholders. It is equally obvious that a firm could invest money for its shareholders instead of paying dividends. So, chapter number 15, dividend policy or dividend decision. In this, first of all, we will write what does dividends means. It is the cash distribution of earnings. It is a cash distribution of earnings. If it comes from other sources, then it is called liquidating dividends. Dividends are of many types. First is regular dividends. Second is extra dividends. Third is special dividends. And fourth is stock dividends. What is regular dividend? It is a company expect to maintain, to give it to its shareholders. That is a regular dividend. What is extra dividend? It may not be repeated. It is an extra dividend. What is special dividend? It is unlikely to be repeated. It is given on the special occasions or special transactions. What is stock dividend? It is paid in the form of shares. These are the types of dividends. What is the What are the dividends? Types of dividends we had done. Why a dividend policy is important? Why it is important? Because the main objective of the financial management is to maximize the market value of equity shares, as it is a key area to study the relationship between the dividend policy and market price of the equity share. In regard, dividend policy assumes significance. Why it assumes significance? Let's discuss. Significance of dividend policy. Significance of dividend policy in two terms. First is long-term financing decisions. That is the equity. हमें पता होना चाहिए कि हम लोग कितना हमारा लॉन्ग टर्म फाइनेंसिंग डिसीजंस है इन फॉर्म ऑफ इक्विटी, तभी हम लोग डिविडेंड पॉलिसी को प्रिपेयर कर सकते हैं, उसका वो रोल है. सेकेंड इज वेल्थ मैक्सिमाइजेशन डिसीजन. इन दो टर्म्स पे हमारी डिविडेंड पॉलिसी की का इम्पोर्टेंट रोल है, ताकि हम लॉन्ग टर्म फाइनेंसिंग डिसीजंस ले सकें और अपनी वेल्थ मैक्सिमाइजेशन डिसीजंस को ले सकें. दिस इज द सिग्निफिकेंस ऑफ dividend policy. So we had done with introduction, what are the dividends, why dividend policy is important, significance of dividend policy, types of dividends. Significance of dividend policy is long-term financing decisions and the wealth maximization that you will do by your own. You will have a look on these two terms. What is long-term financing decision and what is the wealth maximization decisions? Types of dividend. Dividend can be of three types: cash dividend, stock dividend, and there are two types: cash dividend and stock dividend. Earlier, if it comes from other sources, it is called liquidating. It has many types. These are the liquidating dividing types. Next, we will do the types of dividend. First is the cash dividend and second is the stock dividend. Cash dividend is in the form of cash, check, warrant, demand draft, pay order or ECS, but not in kind. What is the stock dividend? It is the bonus shares. Distribution of shares in lieu of the cash dividend to the existing shareholders when the company issues further shares to its existing shareholder without consideration. It is called the bonus shares or stock dividend. Such shares are distributed proportionately, retaining the proportionately ownership of a company. There are advantages to both the shareholders and to the companies. What are the advantages? What are the limitations? Advantages on the viewpoint of tax benefit, in the viewpoint of policy of paying the fixed dividend per share. To the company, it is conservation of the cash for meeting the most profitable investment opportunities. And B is the cash deficiency restrictions imposed by lenders to pay the cash dividend. Accordingly, stock dividends are, ये हम लोग क्यों देते हैं, स्टॉक डिविडेंड्स के एडवांटेजेस क्या हैं, ताकि हमारा कैश बचा रहे, कैश की डेफिशिएंसी ना हो, शेयर होल्डर्स के व्यू पॉइंट से टैक्स का बेनिफिट मिल जाता है और पॉलिसी ऑफ पेइंग द फिक्स्ड डिविडेंड पर शेयर वो भी हमें मिल जाती है इन कंटिन्यूशन इवन आफ्टर द डिक्लेरेशन ऑफ stock dividend. Increase the total cash dividend of the shareholders in future. Limitations that you will do by your own. Next, we will discuss the dividend models. They are very, very important. So let's discuss the Dividend models. There are 5 types of models that we have to discuss. First is the Graham and Dodd model, that is also traditional. Second is Volta's model. In dividend decisions, dividend models are important and उनके अपने formulas हैं. इसको अपने formulas बिल्कुल ठीक से पढ़ने हैं और इस accordingly इसके practical questions solve करने हैं. It is a small chapter or is a very important chapter in examination viewpoint only based on the formulas. different authors ने different models बनाए हैं और अपना formulas दिए हैं. Gordon model, model and dividend discount model. Let's discuss one by one model. First of all, Graham's and Dodd model, that is the traditional model. The formula is P is equal to M D plus A upon Q. It was founded by Graham and Dodd. Market price of the share will increase when the company declares the dividend rather than when it does not. It is a traditional model. Quantitatively, we can say P is equal to M D plus A upon Q. Whereas P is equal to market price per share, M is equal to multiplier and D is equal to dividend per share, and here A upon, we can say E, it is not Q. E is equal to earning per share. This is the Graham and Dodd model. Next is the Volta model. Volta model formula is P is equal to D plus R upon K E minus D. These formula that you have to properly इसको आपने याद करना इन formulas को authors ने दिए हुए हैं. Accordingly इसके basis पे ही आपने questions solve करने हैं. R is equal to internal rate of return. K is equal to cost of capital, whereas E is dividend per share, D is dividend per share, E is earning per share, and P is market price per share. This is the Volta model. Volta model is founded by James Volta. Dividend policy has an impact on the share valuation. Dividends are relevant. Volta model is the relationship between the return on firm's investment, that is R, and its cost of capital, R and KE. If the return on investment exceeds the cost of capital, then the firm should retain the earnings, whereas it should distribute the earnings to the shareholders in the form of cash at a required rate of return exceeds the expected rate of return on the firm's investment. The rationale is R means the rate of return, internal rate of return. Internal rate of return is greater than the cost of capital. If a firm is able to earn more than what the shareholder could be reinvesting, if the earnings of the are paid to them, then R is less than the shareholders can earn higher rate of investing somewhere else. So what does a Volta model says? It says the relationship between internal rate of return and the cost of capital. रिटर्न ऑन इन्वेस्टमेंट ज्यादा होगी तो हमें अपनी फर्म में अर्निंग्स को रिटेन करके रखना है, whereas हमें उसको डिस्ट्रीब्यूट टू द शेयर होल्डर्स नहीं करना. It is a relationship between the R, internal rate of return ज्यादा होगी अगर cost of capital से, तब firm is able to what the shareholder could be by reinvesting if the earnings are paid to them. It means हमें उनको डिविडेंड्स की फॉर्म में तो देना ही देना है, अपनी कुछ अर्निंग्स को रिटेन करके रखना है. किस तरह से पता चलेगा? ड्यू टू इंटरनल रेट ऑफ रिटर्न. Assumptions you will do by your own. Next we will do the Gordon model. What does Gordon model says? We will see PO is equal to D1 upon KE minus G. D1 is equal to D0 1 plus G. Whereas PO is equal to market price per share ex dividend and D0 is the current year dividend. D1 is the expected dividend and G is equal to the growth rate. K is the cost of capital. So, Gordon model was founded by Myron Gordon. This has the impact on the share valuation. It is in 1962. It says investors prefer early resolution of uncertainty and willing to pay higher prices of the shares that offers the greater current dividends. इन्वेस्टर्स वहां पर प्रेफर करना चाहते हैं अपने इन्वेस्ट करने के लिए जहां पर उनको करंट डिविडेंड ज्यादा मिले. It suggests on the two terms, higher the earnings retention rate, greater will be the future return on investments. We can say higher the earning retention rate, then higher the earning retention rate, greater will be the required future return on from investments. This Gordon model says. Second, what does it say? It says The risk of attitude of the investors will ensure that R will rise with each successive years in the future to reflect the growth uncertainty. Second, it says about the risk attitude depends upon the R, that is the internal rate of return. It is based on the assumption R and K are constant. Firm has the perpetual life. Firm has all equity firm. Firm is an all equity firm. There is no external financing. Only through retained earning finance investment programs are there. Retention ratio is constant and K is greater than the P into R. Formula is this D1 upon KE minus G. Growth rate is B into R. Growth rate is equal to retention ratio multiplied by ROI. So here I will write growth rate, that is G, is equal to B into R, or we can say retention ratio multiplied by ROI. Next is the model. This model, the formula is same. Formula is same. And what is the difference between the Gordon model and model? We will discuss. It is founded by Miller and Modigilani. The price of the market price of the share does not depend upon the dividend payout ratio. When profits are used to declare dividends, dividends are out of the profits. The automatically market price increases. At the same time, there is fall in the reserves for the reinvestment. कंपनी reinvestment नहीं कर सकती अगर वो dividend पे कर रही है. प्रॉफिट में से ही वो रिटेन अर्निंग्स निकालेगी. प्रॉफिट में से ही वो क्या करेगी, अपने डिविडेंड्स पे करेगी, बिकॉज डिविडेंड इज अ पार्ट ऑफ प्रॉफिट, रिजर्व्स इज अ पार्ट ऑफ प्रॉफिट. अगर हम डिविडेंड के फॉर्म में दे देंगे देन हमारे फॉल हो जाएगा रिजर्व्स फॉर री इन्वेस्टमेंट. अगर हमें एक्सपेंशन करनी है, we want to expand, company raises additional capital by issuing new shares. Therefore, increase in overall number of shares will lead to fall in the market price of the shares. This is the model, or we can say dividend irrelevancy model. This residual method that you will do by your own. Next is the dividend discount model. Dividend discount model. There are three types of dividend discount model. First is the constant dividend model. Second is constant growth dividend model. And third is two-stage dividend growth model. In constant dividend model, formula is P is equal to D1 upon KE. P is equal to the intrinsic value of the share. Second is D1. It is the expected dividend. KE is the appropriate discounting factor. This is the dividend discount model is theoretically, you can have a look. Next, P is equal to T1. If it is a growth, then K minus G. And P0 is T1, 1 minus 1 plus growth divided by 1 plus internal rate of return power n whole divided by R minus G plus D1, 1 plus G n minus 1, 1 plus G1, that is G2 minus G2, 1 upon 1 plus R की power n. It is just a two-stage growth model. Only formula is important. Dividend discount model is a model which calculates the value of the equity share at the present value of future dividend expected from it. Because इसके अंदर हमारा discounted cash flows चलते हैं जो हमने उसमें पढ़े थे present value factors पे internal rate of return कैसे निकालते हैं. It is popularized by John Burr Williams, the theory of the investment value. There are constant growth and two-stage dividend growth model. And last is the Linters model. Linters model. There are two types of things that we have to take care of. First is the target payout ratio, and second is spread at which current dividends adjust to the target. Formula is D1 is equal to D0 plus EPS multiplied by target payout ratio minus D0 into AF, whereas D1 is equal to dividend in year 1, D0 is dividend in year 0, and AF is the adjustment factor. So this Linters model is based on the series of interviews that he conducted with the corporate managers in mid 1950s. There are following assumptions that long-term dividend payout ratios should have. It maintains a fixed dividend payout. Managers are concerned with changes in the dividend. Dividend changes follow the changes with the long run on the sustainable earnings, and managers can reluctant to affect the dividend changes that may have to be reversed. This is a formula. And the thing that we have to do in the dividend policy, the topics are Gordon Graham's model, traditional model, model, dividend discount model, Volta model. These models are very, very important, and they have the fixed formula. According to the fixed formula, we have to do the practical portions. Next topic is the measures of the dividend policy. Measures of the dividend policy means हम लोग dividends को कैसे measure करते हैं. First is dividend payout ratio निकाल के, dividend yield ratio निकाल के, earning yields. It measures the percentage of earnings of the company pays in the dividends. Dividends upon earnings. Dividend yield is dividend upon stock price. Earning yield is earnings upon stock price. This is again Modi, Gilani and Miller that we have done. And the last topic we have done with dividend model, and last topic is the determinants of the dividend policy. There are 7 determinants like the factors affecting the capital structure like flexibility, sales, growth sales, control. These are the determinants of the capital structure. Similarly, there are determinants of the dividend policy जो हमारे को dividend policy को affect करती हैं. First of all, it is dividend payout ratio. This is very important because इसमें से ही हमारे कंप्यूट होके आते हैं क्वेश्चंस एमसीक्यूज टाइप के. डिविडेंड पे आउट रेशियो क्या होती है? वो रेशियो होती है जिसमें हम लोग वी कैन से डिविडेंड अपॉन अर्निंग्स. It is the maximizing the wealth of the firm's owners and providing sufficient funds to the finance growth. जितनी डिविडेंड पे आउट रेशियो अच्छी होगी उतना ही हमारा कंपनी के जो 2 ऑब्जेक्टिव है मैक्सिमाइज द वेल्थ और एफिशिएंट फंड्स को, उस पे हमारी डिपेंड करेगी डिविडेंड पॉलिसी. स्टेबिलिटी ऑफ द डिविडेंड. अगर हमारी पॉलिसी कंसिस्टेंट है, मिनिमम डिविडेंड हम रेगुलरली पे कर रहे हैं, देन हमारी डिविडेंड पे आउट रेशियो भी कांस्टेंट है और कांस्टेंट डिविडेंड प्लस शेयर प्लस समथिंग एक्स्ट्रा भी दे रहे हैं, उस पे भी हमारी इंफॉर्मेशन पे efficient working of the company पे डिपेंड करती है हमारी डिविडेंड की डिसीजंस. थर्ड इज द लीगल कॉन्ट्रैक्चुअल इंटरनल कंस्ट्रेंट्स एंड रिस्ट्रिक्शंस. कुछ ऐसी गाइडलाइंस आई हैं फ्रॉम सेबी, फ्रॉम अदर गवर्नमेंट, फ्रॉम इंसॉल्वेंसी, फ्रॉम नेटवर्क, किसी ऑर्गेनाइजेशन. इन सबको देखते हुए ही हमें अपने डिविडेंड्स को डिक्लेयर करना है. दिस इज अ मेन फैक्टर इन डिविडेंड पॉलिसीज. ओनर्स कंसिडरेशन. हमें they may include the tax status of the shareholders, their opportunities for the investment dilution in the ownership. इन ओनर्स की कंसिडरेशन को देखते हुए भी हमने अपने डिविडेंड की पॉलिसीज में को हमने रेगुलराइज करना है. कैपिटल मार्केट कंडीशंस एंड इन्फ्लेशंस. हमें अपनी कैपिटल मार्केट की कंडीशंस को रेट ऑफ इन्फ्लेशन को देखते हुए अपनी डिविडेंड पॉलिसी को डिटरमाइन करना. द टॉपिक डिविडेंड decisions and tax considerations that you will do by your own. What are the stock splits? This is very important. एग्जाम में आपको फिलिंग द ब्लैंक्स एमसीक्यू टाइप इस टाइप में पूछा जा सकता है. इट मीन्स हमने अपने शेयर्स को स्प्लिट कर दिया. से ₹1 into 5 shares of 20. Stock splits is a tool used by companies to regulate the prices of the shares. If a share price increase beyond the limit, अगर वो limit से beyond चला गया, then it may become less tradable. So हमने shares को split कर दिया, that is stock splits. So you will do the advantages and limitations on your own. With this, we have completed with the dividend decisions. We had done the determinants of dividend policies. We had done with the capital structure theories. The practical questions from question number 33 has started. I hope that you will revise each and every question. In case we still have 5 minutes left. In case of any doubt, any question in your mind, you may please ask. If you have any question, okay. So as we have discussed, there are 18 chapters we had done today with capital structure and dividend decisions. So I hope that you will revise all your chapters that is still जो हमारे हो चुके हैं अभी तक, because introduction to financial management, sources of finance और हमारे cost of capital, capital structure, dividend decision, हमारा approximately we can say 20 or 15 to we can say 15 to 17 or 18 marks we have covered till now in these 3 classes. Revise each and every question of your study module, and I will share the contents of today's class plus PPT with you in your group soon. In case of any doubt, you may please ask. And thank you so much for the today's class and have with the good patience. Thank you so much.